There's not a lot of life insurance companies that offer it or have it, just so you guys know. Or one way you can get your money from the policy is if you are deemed terminally ill. But again, that is a sad way to get money from a life insurance policy. But it is a way to get money from a life insurance policy. The second way is a dumb way, okay? Which is to withdraw. Okay, I got $12 million in there. Let me withdraw my money. That is a dumb way. Why is that a dumb money? Because a couple things here happen. FIFO means first in, first out. Okay? Growing in cash value. So it's also being credited 4%. And so one of the things that insurance companies do, then they have this provision called the zero cost wash loan. So to just let you know, what could you do with $1 million from your policy? You can fund a business. You can fund and buy more real estate. You can take advantage of opportunities that might come your way. In a case in music, he might fund his next record or records, sign on his new artists through getting a loan from his own life insurance policy, because he initially funded it with $2 to $3 million to do that, because you want to treat a life insurance policy like a bank or a checking account. You want to have what they call a capitalization phase. You want to capitalize your life insurance policy, so therefore you can finally get inside the policy and start earning a rate of return. So therefore it can grow and start compounding. What you also have to look at is the insurance companies also have cash surrender values that's inside the policy. In other words, for a period of time and declining over. Fixed universal life is not a security, which means it's not a typical stock, bond, and mutual fund. You're doing this through the transactions of the insurance company, and this $1 million is basically collateralized through your death, which will be payable through your death benefit upon your passing. In the meantime, the insurance company charges you 4% for the loan. So in this case, they're charging you 40 grand. But since they collateralized your $1 million payable back by the death benefit, your $1 million is actually still, so your principal is taken out of the policy and then your interest, okay? And so what happens is if you pull this money out via a withdrawal, you permanently reduce the cash value and death benefit within inside the policy, and to be able to put that back in via after a withdrawal is very difficult, because you permanently then reduce the cash value and death benefit by creating a withdrawal. Now you can take money out from your policy as a withdrawal, but it is the dumb way to do it, because you don't get taxed on money you get from a loan. So when you loan money from a policy, let's say you want to take, in this situation, $1 million from a $12 million cash value accumulation within inside a policy. The dumb way is to withdraw $1 million, okay? Because dollar per dollar, you lose cash value and death benefit from the policy day one, okay? You lose $1 million. Or you can loan it from the policy. And here's what happens. Here's a cool thing about the smart way of loaning money from a life insurance. If you buy a life insurance policy and then under IRS code 101A, all this money here, this death benefit, you don't have to pay a dime in tax. Why? Because you took care of yourself. And if you take care of yourself as a private citizen, you're not going to be sitting in my line for Section 8. You're not sitting in my line at Social Security. You're not sitting in my line for other government benefits, island card or food stamps, etc., etc. You're not dependent, bottom line, on the bottom line, because you as a citizen took care of yourself and you took care of your family. That's why we now, okay, so you lose your position in the market. So you lost some gains and some advantage you had with dollar cost averaging. Basically, you have to sell your positions in the stock market in your 401k or 403b plan, your brokerage account, to get the $1 million out, okay? And then in those plans also too, you have to pay them back. Otherwise, it becomes a taxable distribution. If you don't pay back your 401k loan, you won't pay back your retirement plan on these things. Now here inside a loan, in an insurance policy, you do not have to get money out of your life insurance policy. 1, sad way. 2, dumb way. 3, smart way. Let's go with sad. Now, if something happens to Waka Flocka, sadly, something happens to a policyholder with an in-force contract, sadly, when they pass away, they will receive the death benefit. In this example, a $15 million death benefit. So sadly, to get money out of the policy, somebody sadly has to pass away. Somebody has to die, which is the traditional way. Allowed it to earn a rate of return, allowed to earn an interest rate, and through the interest he's earning through the life insurance contracts, he's able to loan it back out of the policy without paying a dime in tax and fund his next deal or opportunities. So there's some sexy things that is happening, and I'll tell you this. I don't know what's going to happen in our country in the next 3, 4, 5 years. All I know is most likely going to be scary and very rocky. And for those that take advantage of what they have today, I don't know if you have a lot of money inside savings. I don't know if you have a lot of money. We're going to put money in a 3, 4, 5-year period. You're going to have a guaranteed column. You're going to have a non-guaranteed column, and you're going to have your death benefit. So all this money grows. Let's say Waka Flocka's money grows here to 12 million bucks. Okay? Now the thing here, notice is all the way down here. Because money that you put inside a policy, his borrow from that, what he didn't say in that video was when. When? Now, I'm not so sure if he's going to borrow in the first year, or second year, or third year. Not advised. You wouldn't trust your own mother's money into. So again, these are my life insurance policies. That's not for my clients. This is our family. It's my children. It's for my wife and I. We got multiple policies because we have multiple needs and multiple time frames that we want to use those policies. Matt, why all the different life insurance policies? Because I started off these life insurance policies when I was broke. Some of you guys think that you need to be rich to start this. I started this when I had only 150 bucks a month to tuck away. And then I started making more money in 250, and I started making more money in 350. I started taking my money in a big benefit. So if he puts $2 to $3 million into a policy, he'll qualify for and he gets qualified for the policy, the death benefit is going to be a $10 million policy. Now, the knock on this, a lot of people say, hey Matt, you know, the challenge I've heard online is that when somebody passes away, beneficiary receives the death benefit, but none of the cash. That's true under option A. But if you are an insurance agent, if you're working together with your insurance agent that knows this stuff, ask them for option B, or what they call an increasing that. The other way, it's not the smart way, is basically loan from the policy. People say, well, why I got a loan from my life insurance policy? It's my money, right? Well, it's funny how people have that knee-jerk reaction when they do the same thing with real estate all the time. Oh, Matt, you know, I bought this house at $100,000. Now it's worth $500,000. I got $400,000 equity. Well, how do you get it out? Well, I can sell the house, get the $400,000, or I can stay in the house and do a cash out withdrawal, cash out refinance, and strategically refinance the house. Every time you make money inside your brokerage account, you buy and sell stock, capital gain, offset by the capital losses. You have to pay now taxes. You have $20 million inside there, inside a 401k or a 403b. You deferred taxes your entire life. Now you got to pull this money out. Guess what you got to pay now? This $12 million was inside these different tax structures. You have to pay tax. Well, guess what tax strategy allows you to grow your money tax-free, to accumulate your money tax-free, that you're not here to set up the policy and then pull the money out and then close it like you treat it like a credit card or a bank account. And you have to ask yourself why. Why is such great tax provisions within inside the life insurance industry? Well, how come the 401k don't have this? How come a 403b? How come cryptocurrency don't have it? How come real estate don't even have this? But think about the good, the social good that life insurance does for the community. And you have to look at tax codes. You got to look at tax codes and say, what is the incentive? Uncle Sam, make sure your insurance agent is not overselling and overinflating what they can illustrate inside the cash value accumulation side of life insurance policy. So you make sure your insurance agent knows about that law. If they don't know the law, then that agent isn't trained in the strategy. They should know. And probably I'm doing the homework for the insurance agent watching this, because listen, I know my competitors watch this as well. So listen, I don't care if my competitors watch this. I want to help the industry. I want to help people out there with the finance. I want to help our industry increase its game, so therefore it can serve and help. And withdraw your money without paying a dime in tax. And then something happens to you, the money blossoms in value to your next generation without paying a dime in tax. Well, guess what? That falls under IRS code 7702. Who lives inside IRS 7702? The life insurance industry. What a great industry, right? So here, in this scenario, now, if you got 12 million bucks, how do I get my money? Show me the money. Okay, great. Now let me get my money. Here are 3 ways. House, and take out the equity inside the house, even though my mortgage payment goes up, but now I have control of the equity. Now I can go invest into more real estate. People don't think it's a knee-jerk reaction to loan to get equity out of the house to buy real estate, but I think it's weird that you loan from a life insurance policy. With the nomenclature of loan for a life insurance contract helps you strategically, because money that is loaned from a life insurance policy is not deemed as either earned, passive, or portfolio income, therefore non-taxable. Right? There's all sorts of different marketing terms to talk about what this does. But basically, when you see those kind of buzzwords in the insurance industry, this, generally speaking, this is what they're talking about. So I've been doing this now for 23 years. I've been specifically training this stuff since 2005, and something we've done across the country for clients over and over and over and over again. And one of my favorite clients is my mom. You know, we always say in the financial services world, don't ever put your clients' money into something that you hope that you start thinking about when it comes to this beautiful world of financial literacy, awareness, and implementation to get you to where you want to go. Again, make sure cash flow is established, because this is nothing if you don't have consistent cash flow and security of your income, because this right here can implode if you end up spending down your money too soon, too fast. So that's the danger of this too as well. If you end up spending this money too soon and you don't completely fund it altogether with what you thought it'd be, it's not suitable and appropriate for you. So that being said, death benefit, because the policy is also going to include not only the death benefit, but also the cash that's inside the policy. So if something were to happen to Waka Flocka, and he chose option B on his insurance policy, he'll not only receive, in this example, a $10 million death benefit, but let's say he's got $600,000 inside the policy. He's also going to see whatever cash value that's also inside the policy, so it's a combined benefit. So this is how you accumulate money inside a life insurance policy. It became seven figure. I started making more money and became $1,000 a month, and became $2,000 a month, and I needed to get another policy because I bought a house and my responsibility changed. I had 1 kid, 2 kids, 3 kids. I get another policy because I started filling up these policies because I was going to start conflicting with the TEFRA guidelines of overfunding a policy, and that's why I needed to get another policy, or some of the policies have actually just increased my death benefit, and some of that's starting from scratch all over again. But these are some of the things that are alive, young and healthy. Take advantage of this if you can, if it's suitable and appropriate for you. And for a lot of people, it's not. So when you're looking at this, this is not a get-rich-quick strategy overnight. Please don't treat this like a bank account or a credit union account or a credit card. This does take some time to ramp up. Some fancy words a lot of people call this strategy. They call this infinite banking. Okay, missed fortune, right? Max funded, be your own bank, where a lot of people thought life insurance policy was all about. Now here's another thing, another sad way, but not so sad, especially if you're going through it. Let's say you had a heart attack, stroke, cancer, or you're older in age, you can't take care of yourself, you need some home health care, or you got injured on the job and you can't take care of yourself, you need somebody to help you around. Well, you can qualify for a critical illness benefit if the properly structured life insurance policy has living benefit provisions in it. It's part of the, but this is based on, this is the cash value, what's going to look like as an example. By the way, don't hold me to these numbers. These are just general ballpark numbers of what you should see inside a life insurance contract if this is something you want to do. But there's guaranteed and non-guaranteed based on current interest rates the policy is crediting, based on current projections if it's an index universal life that is going to project. And by the way, there's specific rules now inside index universal life contracts based on certain regulations that were passed to make help more people. Because the challenge today is that in terms of life insurance, the challenge today is not that people don't have the right type of life insurance. That's not the challenge we have today. The challenge we have today is people don't have any insurance, period. Okay, that's the biggest challenge we have. The massive amount of uninsured people. And you got to rely on GoFundMe's and all that type of stuff, which is never supposed to be created for emergency and or death benefit purposes. But back to this, let me get off my soapbox. Based on this column now, as this money grows policy, unlike money that you might have in a brokerage account, money that you might have inside a 401k, money that you might have inside a 403b or 457 plan, when you loan from those type of scenarios, those type of tax structures, the company actually has to sell your position in the stock market that day. So that's why they tell you at the close of business, we'll sell your stock and then we'll send you a check. Okay? So what happens is whatever your value or whether the stock market value of your portfolio was that day, they have to sell, in this case, $1 million of stock. What are you trying to get me to do? So for example, in society, if there's an entrepreneur that's taking on the most risk, he's putting all his money on the line, he's putting his credit on the line, time and effort and energy to create jobs, to create products and services that the government could not do. Guess what the government in return exchanges to the entrepreneur? Well, if you're going to take on all that risk, we're going to give you certain tax provisions. The government says, listen, if you take care of yourself, if you financially take care of yourself, even if he's got $2 to $3 million into this thing, he's funneling it over a 4 or 5 year period, he's in alignment with the tax guidelines at TEFRA, and TAMRA. Now this policy is deemed tax advantaged. He either has index universal life policy, universal life, or whole life policy. Okay, now he's got 12, let's say for example, he's got $12 million into this thing. Woo! Okay? If you had this money inside a brokerage account, what are you paying every year? And it's not inside an IRA or what they call a qualified plan, you have to pay tax. And put it in the comment section below, I am tomorrow's old money. Put it in the comment section below if you believe that is you. Okay, so you put your money, so Waka Flocka is putting money in. Okay, this is you. It doesn't have to be 600 grand, it doesn't have to be 2-3 million bucks. It could be $200,000-$300,000. It could be $20,000 to $30,000. It could be $5,000, $10,000, $15,000. Whatever. It's all relative to you and what you want and what you're looking to accomplish. But I'm just taking it from his scenario. I presume that this is usually the strategy what's happening. He's putting $600,000 for 5 years into. We allow you certain tax provisions to take advantage of if you as a citizen do so. So if you are educated about what life insurance can do, forget this fancy strategy here. Think about this. Do you want to leave your family a financial inheritance? Do you want to leave the people that you love and care about a financial head start much greater than when you had when you were coming up? Do you? Well, that's what life insurance does. So back to the strategy. Now this is all set up, right? Waka Flocka's policy, and the ledger will show a guaranteed, non-guaranteed column based on current interest rates and guaranteed interest rates inside the policy. And based on that amount of money, he'll qualify for a certain amount of death benefit. Now I have zero clue what the death benefit is for Waka Flocka. I'm not sure exactly how old he is, what type of health he has, and what type of death benefit he qualified for. A typical example would be, if he's putting $2 to $3 million in here, and he's probably most likely, what is he, in his 30s? Somewhere around those lines, probably in his 30s, like mid-30s, and most likely to qualify for a healthy death period of time. For the first 10 to 15 years with most life insurance contracts, they will not allow you to touch all of your money all at the same time, especially at the beginning. So the surrender charges, a lot of people say, well, you know, life insurance has a lot of charges. A lot of times in life insurance, those charges only apply if you surrender the policy, which is something you should not do when you set up this type of strategy. In other words, if you set up the strategy, you should have the mindset to die with this policy, in force, pay it back. So what the insurance company does, they set aside $1 million, okay? They don't sell your position in the market. They allow you to loan $1 million loan, and you collateralize the cash value you have inside the policy without selling your position. In this case, if you're talking about an index universal life policy, they don't sell your position inside the index of the gains or the loss of the stock market. They don't sell your position wherever you're at that particular point inside the stock market. Which, by the way, inside the equity of your home, I don't know if you have a lot of money sitting on the side somewhere not doing anything, but these are some of the things that you need to consider thinking about after watching the video. Again, it may not be me, all good, but talk to somebody. Surround yourself with wise counselors and advisors to help you understand what your advantages are in an industry where a lot of people thought it was just for dying. There is the word life in the word life insurance, and therefore you should take advantage of it when you are. And accumulates, because there's a couple phases. There's a contribution phase, and then there's accumulation phase, right? And now there's a distribution phase. And another phase we'll talk about later on, which is transfer phases, which is why my wife and I have wills and trusts, and we sat down with an attorney to make sure all of our assets and life insurance and everything that we own goes into a trust. Okay, we sat down with our attorney, we got it all drafted up to make sure we become tomorrow's old money. How many of you guys want to become tomorrow's old money? Amen.